Hello everyone, happy Monday. Today on the final bar, we're going to look at the market from three different angles. The big picture perspective, looking at the macro reads from the sector level, looking at sector movements and rotations. And then bottom up, a segment called Shifting Stocks, where we look at stock movements and what they mean. A lot of buying going into the close here. So just when you thought we were in a raging bear market, we get a day like this making us all question what's next. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com. Welcome to the show on a volatile Monday. As I mentioned in the introduction, as we feel like we're in distribution mode. And last week felt like we were digesting gains, sort of hitting an equilibrium. Today comes in and we get a jump out of the open and then just chipping away higher and higher, and then a huge up move right into the close. I've joked with friends of mine, if you really want to challenge yourself, try to do a closing bell show in this market environment, because boy, the last 30 minutes usually end up being kind of fun. But overall, certainly a nice up move. As I was reviewing stocks over the weekend, I was taking a lot of notes just about stocks approaching key levels, a lot of stocks sort of teasing the 50 and 200 days, just sort of seeing what happens. And as we're going to see in our shifting stock segments, a lot of stocks starting to potentially follow through to the upside. So we'll see what all that means. In the short term, I just wanted to remind you of some really good events coming up on this channel on StockCharts TV. Today, we actually had our most recent episode of Behind the Charts with Chris Shavacco. Chris is a money manager based outside of Atlanta. If you missed that, no problem. Go to our YouTube channel. You can see that. But he did a great job talking about, honestly, how he uses stock charts to look at market history and investor psychology. Also on this show, remaining of the week, Tuesday, we have Harry Boxer. On Wednesday, Jesse Felder. And on Thursday, John Kozar from Asbury Research. Also tomorrow, I'm going to be doing a special here on StockCharts TV called 7 Bear Market Mistakes and How to Avoid Them. Sort of went through and listed out some of the mistakes that I find people tend to make in bear market cycles, and we'll share with you what they mean. As a preview, one of those is to don't get sucked in by bear market rallies. Timely comment for today as we get to our market recap. So, I had a friend of mine from a trading desk in the Midwest today. We were chatting earlier this morning, and he asked just where I was looking for the market in the coming weeks, just what I was thinking. And I said, listen, bear market rallies are brutal. They're sudden, they're severe, and it's so easy to get sucked in with the upside. And you look at today, the S&P going up over 7%, and a lot of that came in the last, a point and a half of that came in the last 30 minutes. We really accelerated to the upside. But overall, even out of the open, it was just this nice sort of upturn, nice follow through day to the upside. And for me, I think bear market rallies like this are so tempting and so frustrating, especially if you are bearish, especially if you're expecting further downside. It's so challenging. And let's look at what happened today, but then through the course of the show, we're going to look at some of the longer term charts that help put this into context, really think about where we're at, where we've come from, and then hopefully start to piece together where we're headed. So the S&P, as I mentioned, up over 7%, mid caps and small caps up even more. So this is very much a risk on day, sort of a vote of confidence of short-term strength in the market. And again, my only caution to all of you is I think that's the key. The key is short-term. Bear market rallies can be severe and sudden and dramatically positive, but again, the overall trend is what remains negative. So by my read, it's still long-term negative, short-term now positive. The VIX now down below 45. It's down to 44.84, which is down a lot from 70s, 80s where we were not too long ago. On a sector perspective, tech really emerged as the leading sector today, up 8.7%, followed by consumer discretionary, 8.5%. Then we get into more defensive utilities, number 3. At the bottom, we sort of have a rotation away from some of the groups that have been leading. Consumer staples up, but not nearly as much. then healthcare, then energy. Financials, which we'll talk about a bit, sort of right in the middle of the road, sort of a market performer. So you had some sectors just up dramatically. And again, we've talked about the chart of technology as being a great sort of overall read on things. It's been a technology driven market for years, and especially now, that's been the relative strength in the sell off here. So where those that group does, I think, is a great indicator of the overall market health. I changed around just things just a little bit. We're going to talk in shifting stocks, but I did want to note Boeing up almost 20% today. Raytheon up big, so that sort of defense group is up really, really strong today. And I was just curious going into the close, what were the things that were really driving it? Those are the names that were up pretty significantly. Also American Express and Visa. So a whole mix of things. And looking at the chart of Visa, again, if I could summarize the market in one chart, Visa is not too bad. You sort of have this, what appears to be a bottoming sort of accumulation pattern. You have this bullish divergence going into the third week in March. You now have established a higher low. And on my weekend review, I saw a lot of these stocks that had sort of pulled back, and it almost felt like, oh, we're going to come down and retest the lows. And today, now some stocks breaking above that recent swing high, others sort of testing them. And then financials are sort of lower in, have not sort of approached it. But I think Visa's sort of right in the sweet spot. Today, we go right back up to that high from a week and a half ago. And the question is, are we able to sustain that? Is this the beginning of a further push higher, or is it back to reality tomorrow? Again, the reason why bear market rallies can be so severe is it's all headline driven, right? If we get the sense that recovery is going to be more swift, more painless, less difficult, we're going to find those big rallies. And then when, if things turn negative, we get some negative headlines, watch how quickly things can turn around. Just looking really quick at the industry picture, then I do want to look at some macro charts here before we get into some other segments. Home construction was actually number one. Again, a lot of these groups kind of coming off of pretty low levels, but home construction up 15%, over 15%. Also furnishings, also hotels. That's why consumer discretionary was so high up there in the relative list today. Aerospace, as I mentioned, that's Boeing's group, is up pretty big. The defense group, not in the top 10, but also up pretty decently. But you see a lot of these. It's apparel retailers, it's auto parts, it's transportation, it's recreation, it's sort of recovery, feeling like the recovery is going to be less painful. Worth noting, things like airlines, however, did not participate. So even though the world is all fine, according to most charts today, reality is still setting in for airlines, saying they're going to be down, 80, 90% in terms of their expectations for the year. As headlines like that coming out of the airline. So, there are plenty of places that are still feeling a lot of pain, still up, but just very, 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 very little. Overall, it's been relatively muted there for airlines. Did want to just look at a couple macro charts just to think about the big picture here. Let's look at the Mindful Investor Live chart list here. So number one, the market trend. So again, this is today's bar here, broken above the most recent swing high. Again, all these models are still going to be negative. This is the tactical model at the bottom based on the weekly MACD or the weekly PPO. This is the longer term trend following model. All of those still negative. So today is one day, the trend according to that still overall negative. But I did want to focus just on a chart of the S&P 500. The question I'd mentioned with a friend of mine this morning, just thinking about what was next for stocks. Now that we've had today's move and the S&P is now broken above that previous swing high, in the short term, I think you have to admit we now have a higher low and we have a higher high. And the question now is, do we continue that pattern? As long as we continue to chip away with higher lows, we will pull back maybe even tomorrow. I don't know when, but we will. And are we continuing to put in higher lows? As long as that trend continues, the short-term trend is certainly higher. We are approaching a monster resistance level, I think, between 2,700 and 2,750. 2,700 has been support for a while now, and now could potentially become resistance. 2,750 is that first big Fibonacci level, which we are now approaching. So the question is, are we finding resistance here or not? I think we're entering a heavy supply area. I'd be amazed if we're able to break through it, but we'll see. Stranger things have happened, including a 7% rally today in stock. So a lot of interesting charts to go through. Let's go to our next segment, which is sector setup. So what we love to do on Mondays is look at the sector picture right here. Think about how these sectors are evolving relative to one another and start to dig into a couple key themes. So when I'm looking at sectors, I always start with the weekly RRG, the relative rotation graph. Again, if you're not familiar with this, just look at my colleague Julius de Kempener, his show Sector Spotlight does a great job of sort of explaining this methodology. So check out his videos to get more color on it. But essentially, we're looking at how these sectors are rotating around the benchmark in the middle. Technology, the XLK, has been the strength, that's been the juice, that's been the relative winner. So even in up moves and down moves, the XLK has been furthest to the right, which suggests the relative strength. What's interesting is in the last 4 weeks, you can see how the RRG has rotated down. It's not going southwest yet, which is sort of that danger read that tells you that things are starting to deteriorate. This just means that the rate is slowing. So it's still the strongest sector, but the momentum's easing off of it, and it's being compensated for by healthcare, XLV, and consumer staples, the XLP, which have emerged as being the two most promising sectors besides technology. Worth noting that utilities have actually rotated down and now heading southwest. And again, it's not the end of the world. It just tells you it's not necessarily showing you the characteristics of a leading sector. Utes and real estate had been emerging in some really good shape and now both sort of rotating lower. Consumer discretionary and communication services, not horrible, but they're really close to the zero line, which essentially means on a relative basis, they're basically market performers. They're kind of, staying very close to the benchmark, not really differentiated on a relative basis. So not as a sector, not great opportunity there. In terms of what has not been working, energy has been the outlier, far to the lower left quadrant, and certainly an avoid by any technical methodology, I would imagine, besides just trying to buy a falling knife, but overall still on a relative basis, pretty weak. After that, you have financials, you have industrials, which are really, again, showing some negativity. And again, this really doesn't adjust for something like today's move because it's based on weekly data. This is meant to not be noisy. It's meant to be very slow and methodical. So that's what the relative picture is telling you. Tech, healthcare, consumer staples, really the three leading sectors according to this methodology. Let's look at some of the individual sector charts here. I like to start with the candle glance page. And what I'm noticing here is the same thing that I noticed with a lot of the individual stock charts I was looking at over the weekend. You have a lot of things that look like these sector charts, right? So they've all now established, for the most part, a higher low. Many of them have broken above their swing high from the last week or two ago. So healthcare here breaking to a new swing high, jumps out. Consumer staples really gapping higher today above there. Technology, which is here, we'll zoom in for a second, breaking above that high from the last week. So a lot of these sectors sort of rotating and confirming a higher high in the tactical time frame, in that short-term time frame. However, that is not universal, right? So communication services, consumer discretionary has not quite established above their previous swing high. You have the same issue with utilities, with real estate, with materials, with industrials. You can see across the board here, a lot of these sectors are still not following through and getting a higher high from the last week or two. So it's relatively narrow if you look at the sectors, but it's some of the larger sectors. So tech, communication services, healthcare really confirming, and again, not surprisingly, that those are the three sectors that look most attractive on a relative basis on the RRG charts. I want to focus just on a couple sectors very quickly here. Technology is number one. So, this is an interesting sector because it's been a strong relative performer in bull phases and in bear phases overall, right? So even with the sell-off that we've had in stocks this year, you've continued to see the XLK outperforming with this relative line going up and to the right. The XLK rallied back and now is approaching a confluence of resistance. And that means a number of different resistance levels all kind of lining up. The first is the Fibonacci retracement. This is the 38.2% retracement level. If we look at the December 18 low and the February 2020 high, we then retraced over 2/3 of the way down. We found support here at the June lows and then rallied back. And now we're facing that same 38.2% level that has been important before. That's also lining up really well with the 200-day moving average. So if I had sort of one chart to pay attention to, this might be the one, the XLK, because it's hitting that confluence of levels. It's hitting those significant supply areas, an area at which you would expect some profit taking, you'd expect some sellers to come in, buyers to evaporate. If the XLK is able to get above there, get above the 86 level, for example, really get through those levels, get through 85 for sure, that would suggest a much more resilient market, and that this short-term rally is not just a continuation of this dead cat bounce, but it's more of a follow through and that we might have more potential upside here in the short term. I'd have to see the XLK beat those levels first. Second one I want to look at is financials. And this is an interesting one because, the challenge with financials, it's been a relative underperformer. We looked, I want to say last week, at a chart of technology versus financials. Might have inverted that, actually, looking at the XLF over the XLK. And on a relative basis, financials have been underperforming chronically. That's been a chronic underperformance. You can just see in the last 2 years how the XLF overall has been underperforming the S&P, underperforming by 24% on a relative basis just in the last 2 years. And a lot of that came year to date, right, where financials have just been crushed. So have sold off much worse than the average stock and have recovered a lot less than the average stock. That's why the relative strength is so low. So while other sectors have sort of eclipsed that previous swing high, with the XLF, you see something a little different. You see more of a consolidation, more of a triangle pattern, right? Lower highs, higher lows, sort of this consolidation around the 20, 50 level. And again, the question is, if the XLF is able to eclipse this peak 2180 or so from the last week or two, that would maybe give more confidence in a recovery on financials. But again, on a relative basis, there's not much to get excited about in there. Now, looking at individual stocks, we'll hit on a couple of charts that look interesting in the sector, but overall, I think it's a challenging sector, and especially on a relative basis, it's just not getting the confirmation that we've seen elsewhere. I did want to finish off with consumer staples. Been a very choppy ride with most sectors, but especially for staples. These have been some of the names that people have been most excited about in terms of recovery stories. Things, providing the necessities we would need for an extended homebound experience. Some confidence over the weekend that sort of reflected on the rallying market today that might not be as difficult as the market had priced in. And in the short term, we're certainly seeing that. The sector not up as much, up 3.5% when the broad index was up almost double that. But overall, still on a relative basis, doing pretty well. And there are plenty of charts within consumer staples that remain fairly attractive. So I think it's more of a stock picking exercise to look within that sector and others. That's our segment, sector setups. And again, some really interesting movements on sectors, and a couple sectors really getting it done on a Hello, everyone. Welcome back to the show. I'm Dave Keller with StockCharts.com. Thanks for joining me every weekday for the final bar. We are here to answer your questions, help you navigate these markets. No question is out of bounds in terms of market dynamics, technical analysis, behavioral analysis, whatever it is. We're happy to address your questions on the air. We're going to do a segment tomorrow. So hit us with your questions via email at thefinalbar@stockcharts.com. Love to answer your questions tomorrow. Our next segment is called Shifting Stocks, and as I've mentioned to you as a group and many of you individually over the years, part of my weekend routine is to look at the S&P 500 and go through the individual stocks. And it takes a little bit amount of time. It's taken less and less time as the years have gone on, but I have found it is a fantastic exercise, especially if you look at a lot of long-term macro charts. If you're looking at broad indexes and commodities and currencies and all that, looking at a bunch of charts from a bottom-up perspective and looking at them the same way every week is such a great journey that you can go on, because you will find patterns emerge in the individual stocks that eventually will be reflected in the broader indexes, but they become way more clear when you look at the stocks and the industries and the groups and all of that. So I'd encourage you to think about some of the ways that you can incorporate more bottom-up work. If you're not, if you're more of a big picture person, that's fine, but it really can be helpful to your process. I just wanted to walk through some of the charts that jumped off the page at me as I was going through some of the charts this weekend, and hopefully leads us to some good thoughts. So first off, as I was looking at the very first the ticker in my list, I go alphabetically by sector, and then I start by group within each sector. So I start within communication services, and I'm looking at the entertainment names, and the first ticker I look at every week is Charter, CHTR. And it's funny, it's actually became a perfect example. The more charts I look like, I kept thinking to myself, wow, it looks a lot like Charter. And so I thought it was a really interesting one to just start with. I mean, this kind of encapsulates where the market is right now. I think, we rallied into the peak about a week and a half ago. We pulled back and now have established a higher low. And through the end of last week, you sort of started to sort of confirm that. But today's rally sort of confirms that that was a higher low, again, on the shorter term time frame, this tactical time frame. So for me, that's really interesting. What's interesting about Charter, two other things. Number one, it is just closed right at the high from that most recent swing high. So I think tomorrow is a key measurement. It's a key potential follow through day. And as we talked last week in our mailbag segment, what I define as a follow through is you have this signal, right? This stock has gone to a new swing high. Do we get confirmation tomorrow? Do we follow through in the direction of the breakout? Do we get a suggestion that we didn't spend all of our chips getting to that point? Do we have more gas in the tank to continue further and continue that momentum? Are buyers still remaining? And that's what I think we would potentially find tomorrow. So this is, traded higher today, closed right at that level. Are we able to get a higher close tomorrow as it broke above that swing high and once again regained the 200-day moving average? One of the things we've talked about from a breadth perspective is how few stocks have eclipsed their 50-day or their 200-day. And I'm finding, like with Charter and some other charts we're going to look at today, I'm seeing a lot of stocks really be close or started to eclipse some of those levels. Next one, we're going to stay within communication services and look at some of the video game names. EA is Electronic Arts. What I love about this chart is it looks very different than some of the other ones. So while others are sort of down in this range, sort of figuring out if they can regain the most recent high and sort of get into the next phase of a short-term uptrend, charts like EA are actually nearing more their previous highs, right? This is nearing its high from early 2020. This stock topped out around 114. That's not too far away now. It's had a couple pretty decent weeks. And while other stocks were sort of backing and filling, sort of figuring it out, you can see the relative strength on Electronic Arts has been pretty positive since the third week in February. So overall, a nice follow through today, now back above its 50-day. And again, all else being equal, looks like it's pretty decent, heading to previous resistance in the 111 to 114 range, which is where, unfortunately, I think there's a lot of resistance there, but overall in pretty good shape. And a sister stock to EA would be Activision, ATVI, Activision Blizzard. And you can see similar sort of thing, right? The pullback never really got below the 200-day, a little bit, but never really followed through. It kept closing back higher every time it closed below the 200-day. And again, once again, really nearing those previous highs. So 64.50 was the peak from the third week in February. I'd like to see it able to reclaim those levels. So EA and Activision are actually narrowing, sort of all-time highs, significant highs, which is pretty powerful. These are not, all-time highs. We look back, the stock had come from higher levels, but in the recent year, for sure. Now, when I'm looking at this space, communication services, I automatically want to think of the biggest names in there, and Alphabet sort of dwarfs a lot of them. You can look at Goog, G-O-O-G, or G-O-O-G-L. Pretty comparable in terms of what the patterns are. I've just gotten in the habit of looking at this one. And again, as I mentioned before, it looks a lot like the Charter chart, CHTR, right? So you have this higher low, which just happened on Friday. You've now eclipsed the previous high. My question going through the rest of this week, do we continue? Do we follow through on that upside move? Do we continue there, or are people thrilled at today's update and do we see further distribution as we go on? So it's right at that significant resistance level around 1175 or so on Alphabet. Stock was up even more than the market, 8.25%. Next, I want to just rotate very quickly, get into financials. As I mentioned in our last segment about sectors, the financial sector is in a challenging position just because on a relative basis it's been relatively negative, right? Just has not gotten it done for a long time. But there are pockets within there that are actually looking relatively constructive. BlackRock probably comes to mind. Now, this one is, you think about the different levers you can pull within the financial sector, and you've got asset managers, banks, and brokers. You've got investment banks, insurance companies. So there's a lot of, there's some diverse business models represented there. And BLK is a chart that's actually on a relative basis not done too bad. If you look at it relative to financials, actually held up really well. Again, what concerns me is we have this confluence of resistance similar to the chart of the XLK. Now you compare that chart right there with something like Citigroup, you can see why the biggest names are not looking nearly as good. Look at the relative strength that has been weak. look at the consolidation. It looks more like a chart of the XLF. Instead of breaking to new swing highs, it's nowhere near them. JP Morgan, probably a similar type of pattern, more looks like a triangle pattern than it does a bottoming pattern yet. So it's more hitting equilibrium, and you've not seen the follow through yet from those names. Three more quick charts to look at, and then we have to move on. Within technology, again, it always strikes me as it did again this week, how strong a lot of the tech charts do. And again, look at a chart like Apple. It never really, broke below the 200-day, but never really stayed below there. It's remained sort of above an upward sloping 200-day. It keeps regaining it back above it right now retesting the previous swing high on a relative basis, pulled back, but overall, just a really strong, decent chart. So I think long-term, that's a really good chart to be paying attention to. Two others within tech. One is Western Digital, and the other is CDW. So what strikes me with both of these, I don't want to say any of these charts are easy. There's nothing about this market that is easy, so don't read that too much. But what I would say is with a chart like WDC, and we won't get to CDW, but similar type of pattern, you now have a really clear range. There is support in the last week at 37.50. There is resistance around 45. We are now right between there. If you want to watch one chart and see if we get further short-term upside or see if we fail and break through support, WDC is not a bad one to watch. I'm waiting to see if we get a break above 45 or below 37.50. One of those things is most likely going to happen this week, and I think that will tell you where tech is headed and maybe more broadly speaking, what the overall sentiment is on stocks. So folks, that's our segment, Shifting Stocks. So many individual names to look at. And again, I hope you have part of your process at some time of the week to go through some of those individual names. There's so many great ideas out there. We need to wrap up the show though and go right to our 3 and 3. So 3 charts in 3 minutes. I'm hearing now in my ear we have 2 minutes. That's okay. We're going to do it. We're getting to the S&P 500 as chart number 1. So as I mentioned earlier on, we were talking about the market recap. I think the S&P is at a key moment here. Over the weekend, I was feeling more about, is this a buyable pullback, or is this more the pause before further downside and we retest the lows? I think S&P 2300 is sort of the downside objective you look for. Today was certainly voting more for rally mode. Again, I'm always looking for follow through. So because we traded above and closed above the resistance from last week, that's good. I'd want to see some sort of follow through tomorrow because we could just as easily go back in that range and it's sort of a failed breakout. But if we do get above here, what concerns me with stocks is if I would, look at this big sell-off that we had and look at the rally, it's kind of what I was eyeing is this 2,700 to 2,750 range. That's sort of that confluence of resistance, and then we'd have to eclipse that. I don't know. I don't see us doing it, but again, I'm going to follow the trends, and if we do, you have to bet on further upside. Chart number 2 is with technology, again, facing confluence of resistance. You can see this theme. I see a lot of sectors, a lot of the broad market, some stocks facing key levels and needing that follow through. If the XLK is able to break above 85, 86, that's huge. If not, which I'm afraid we won't, then that tells you potential for the downside. Chart number 3 on our 3 and 3 is JP Morgan. We talked about financials there at the end, looking at JP Morgan, Citigroup, and then other different charts like BlackRock. But with the big names like JPM, what concerns me is it's not as much of a bottoming process. It's more of a bottoming, consolidation, right? So you have this, lower highs, higher lows. This is where things sort of settle into an equilibrium. The question now is, which way do we resolve? Do we resolve this to the upside? Do we resolve this to the downside? And JP Morgan's a really good chart to be watching to see which way we break. And I think that'll tell you about the relative strength with financials, which overall has been muted, has not been a decent place to be. And folks, that's our show for today. Thanks for watching this on a Monday afternoon. I want to remind you all of our previous episodes, including some fantastic guests in the last couple of weeks, are all on our YouTube channel. Just go to YouTube, look for Stock Charts, and you'll see the Final Bar as well as all the other shows that we have going on our channel. We have a lot of great specials that we've come out with recently. We did a couple segments recently on navigating a bear market, on 15 stock ideas, on a lot of great opportunities. Tomorrow we'll be doing my special on 7 bear market mistakes and how to avoid them. I want to thank you all for watching. Keep your feedback coming. The Final Bar at StockCharts.com. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment, we'd love to hear from you, and most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.